Welcome to the stock play of the day. Today's stock is going to be Hartford Financial. We'll discuss should we pass or should we play? Hello, my name is Brian Overby. I am the Senior Options Analyst with Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist with Ally Invest.
Well, Lindsey, on my screen here, I have a chart of the S&P 500 index, and we're heading into June. We see a little bit of positive signs in the charts. What are we seeing as far as the marketplace is concerned with all the news out over the weekend?
Yeah, I mean, surprisingly, maybe the market's up slightly today, at least as of noon when we're speaking here. The market looks good. It's coming off of a really strong May, up like 4.5% in the month of May, which is a really good. It's a really good indicator that June, which usually isn't the greatest month of the year for the stock market for a number of different reasons, it usually means that we can have a little more momentum going into the month of June. So that's certainly a positive thing. We got some economic news out around the globe today. Actually, China reported that their manufacturing index expanded for the first time since the pandemic initially took hold earlier this year. So that was a positive thing if you believe the numbers. We also got manufacturing data here in the U.S., which came in better for the month of May, came in better than the month of April. We're still contracting. So the number was 43, which was under 50, denotes the level of whether you're in contraction or expansion. So China is in expansion. I think did I say contraction earlier? They're in expansion, for the month. But yeah, so despite all the news that came out with the protesting and riots that we saw, I'm here in New York City, saw that over the last couple of nights. You do see that the market is moving higher again. I think on the hopes that the economy is moving forward. We're starting to finally reopen in different parts across the country too. So there's a lot of hope around that. There's a lot of hope around some of the vaccines and drug trials that are going on that really drove the action last week. And I think it's starting to spill over into this week and into the month of June. I think from the technical perspective, Brian, what was interesting last week was we crossed a 200-day moving average for the S&P 500. You can see it there in your chart denoted by that yellow line. We crossed that on Wednesday. We were able to stay above it for the rest of the week. At that time that it crossed there, you'll see the index is right around the 3,000 level, and that's about where the 200-day moving average was when it crossed on Wednesday. Again, that's a very bullish sign for markets. You and I have been talking about the 20-day, the 50-day that you also see on this chart here, and how they've been acting as levels of very strong support. You see in the red line there, the 50-day turning up. That's a positive sign for the market for sure. But these even numbers, especially in the thousands, 3,000, 2,000, 1,000, when the market crosses them, those are really big, round, psychological numbers for investors sometimes. So you can oftentimes see a test of that. Back in 2019, when we first crossed 3,000 in July 2019, we had to break through the 3,000 number level 4 times before we were in a sustained uptrend. And I know you've been looking to, we talk about this almost every week, some of the technicals, not that we're technicians, but we do know the rules of thumbs, and we use those for me to supplement fundamental analysis, for you to supplement your options trading strategies. What are the technicals telling you today?
Well, yes. Okay. A couple of things that are good signs. Right here, when we crossed over the moving average when the 20-day crosses the 50-day to the upside, that's a good sign. And overall, we started to see the market go up, but we still had some chop. Now, the fact that we've broken through that level, and you mentioned it's not only is it the 200-day, it's a 3,000 number. 3,003 was where the 200-day is at. A lot of times you get a little bit of chop before we can move forward, but it's just good overall every day that we finish above that level. And if you look back even when in March, when everything was happening and we crossed to the downside in the 200-day moving average, you had quite a bit of chop. You can just see where the market struggled to try to decide, Are we going to bounce off of this average, or are we going to go to the downside? And obviously, ultimately, it did. We're all the way, we've made over a 50% move back. We're all the way up as far as the Fibonacci numbers to the 61.8 number, 61.8, and we've broken through that. So there's a lot of positive signs when you look at the chart. One of the big negatives for me, though, is that we see an update like we did today in the S&P 500 index, and most of the indexes are either flat to up, but we still see the VIX not coming off. The VIX is around 29%. It's actually up a little bit today, and that's very odd to see an up market and still see the volatility index increase. And the volatility index actually tracks the options in the S&P 500 index. So I would like to see that come off a little bit more. That's the one negative that I see here. Now let's talk about another positive, though. If we look at the NASDAQ here, or the QQQs, which would follow the NASDAQ, I have the NASDAQ chart up. We see that we are breaking through, well, we haven't broke through quite yet, but we're trending back to almost all new highs in the NDX. If I see right here, and I'm going to zoom in on this little corner here, there are a couple of positive things is that we keep coming up trying to break through this ceiling to get all the way up back to where we were way back here when we had an all-time high in the NASDAQ. And if you see here, we've came up and we've touched it 3 times now. So usually the more times it touch a stock or an index will touch a ceiling and not break through, the next time that it approaches it, the chances are a little bit higher that it will actually break through. So in the NASDAQ, it's been a leader the whole way back on this rally back up to normal levels. And it would be great to see the NASDAQ, if we could, break into a new high, a new all-time high, if you will, in the NDX, and also the QQQ, which is the ETF that tracks it. All right, so let's get into the stock today. Here's the chart on the stock. This is Hartford Financial, symbol is HIG. Some thoughts on Hartford?
Yeah, I mean, before I dig into Hartford, a couple things. First, I want to remind our viewers that we actually have upgraded our technology, very exciting stuff here on the Ally YouTube channel. And we are now able to, even though we're still doing the show at home, we're now able to take your questions live. So be sure to write them in the chat box and we'll get to them at the end, whether it's about Brian's options trade or the market or the stock. Feel free to type those out for us. Also, I just wanted to mention your comments about the VIX. You know, it's been hanging around that 30 level, and I think that is maybe the one area that you're seeing in the market, that and potentially occasionally the price of gold, where you're seeing there is some uncertainty out there. There are increasing geopolitical tensions between the US and China, right? We saw President Trump's announcement on Friday, leaving the World Health Organization and no longer treating Hong Kong, not providing them special treatment that we had in the past. You know, that's one of the biggest unknowns out there. Also, we don't know what the future holds with regards to the virus when we get the vaccine, the treatments, if there's going to be a second wave, how fast business can come back. So there are still a lot of question marks out there, even as the economy is reopening, which is a very good thing. And you do see these markets move higher. So I think that's just really what the VIX is showing us, that there is still some uncertainty. But let's dig into the stock here. You got it up, the HIG, Hartford Financial Services. We wanted to take a look at a couple different insurance companies. It can be very nerve-wracking to look at these types of trades when you're in a period like this, which is to say when a catastrophe is happening, or we're just getting through the height of a catastrophe like the pandemic that we just went through. And the reason for that is, Brian, is that it's really hard for companies and analysts and Wall Street to understand what the loss and the cost of this type of catastrophe is going to have for the insurance companies that have to pay out those claims that they wrote. And now normally HIG and some of the other insurers are P&C, property and casualty insurers. So they usually deal with disruptions to your property or the loss of life and things like that. This time around, though, these types of companies are going to be looking at how the coronavirus pandemic has what it's done to interrupt businesses, what it's done what the impact of not paying mortgages has been, employee disputes, and other things that are really kind of hard to to analyze and come up with a cost very easily or quickly. So that's why you see this huge drop off in the stock. It actually fell. It fell about 45% off of its January 19th year to date high, January 17th, I think, year to date high. It has bounced. It's bounced up another about 45%, I think 47% since then, which is a nice bounce. But look, we're still about 20% off of the highs from earlier this year, for sure. So, and you can see it's kind of been trading in this range while the market assesses what the damage is going to be for these guys. Now, the reason it's interesting to look at a company, well, actually, in general, the insurance space and the P&C insurance space in general is what we've seen is about $150 billion worth of market capitalization of all these companies, not just HIG. HIG is included, was lost at the depth of the pullback in the market. And you've got Lloyd's of London and others out there that estimate what the impact is going to be to the industry, saying they're estimating it around $80 to $100 billion. So well below or decently below that $150 billion level of market cap that was taken out. So that's one positive that when you start thinking about how these insurance companies should be pricing. The second thing is while the market's still assessing the situation, what usually happens in these situations, Brian, is that after a catastrophe happens, got a little tongue tied there. What you see is insurance companies raise their rates. They raise pricing. So where you might get a 2 to 4% increase in pricing on an average year, when a catastrophe like this happens, you can see pricing increase much more significantly because they have to reassess what they have insured, and they probably haven't thought of something like this in a while, right? So what happened in 2011, which was a bad year for the insurance industry, they increased prices by 8%. Hartford did. The year before it was 4%. The stock popped after that pricing change was made. So you want to get into these stocks before the pricing change is made. And, if I was a betting woman, I would guess that there's probably some pricing changes coming down the road, which could be a good catalyst for the stock. And Hartford, the reason we decided to look at this one is just from a balance sheet perspective. It's a stronger stock. They have an investment grade rating. That's what I mean by a strong quality stock from a balance sheet perspective. Investment grade rating, the outlook from these rating agencies is that it will be stable. This company's been around since the 1800s. It's seen a lot of things, been a lot of places, right? So it's just something that we wanted to take a look at. And I know that, Brian, you have an interesting options trade that you're looking at as a way to potentially gaining some exposure to the insurance industry.
Yeah, well, we had the week off last week, but the week before we talked about Walmart, and we kind of looked at going into earnings, and it was a little bit more speculative trade, and how we managed our risk when we went into Walmart the other week. This is going to be another one of those fear of missing out trades, the FOMO trades that we've talked about throughout this entire run up back in the markets. So overall, if I look at the chart here on Hartford, we see once again it's trading. It's a little bit of choppy markets, but a fairly wide range that it's trading in. And what we'd like to see is if it could just break out to the upside and make that final move all the way back to where its new highs were. Now, we're still in that choppy period, and we still have high implied volatility because of a lot of the things that you just talked about there, Lindsey. And overall, we looked at Hartford when I looked at a volatility chart before we started our video today. And in the volatility and the downtime where we get the big downturn, the implied volatility was all the way up to 150% on a 30-day at the money option contract basis. Now we see that it's down around the 60% level, which is still quite high. We don't have earnings until the end of July right now, so it's still just that a little bit of uncertainty in the marketplace. So that attracts me to some selling strategies. And a bullish selling strategy that's kind of a fear of missing out trade is a short put spread. So here we see the website for my book, the Options Playbook, and we're looking at the short put spread. So what we're doing is we're trying to sell some of that premium and then buy some protection. So because we have high volatilities, we're going to go out a little bit further in time. We want to avoid earnings. We don't want to be around during that time period. So we're going to go and we're going to use the July expiration, but we're going to sell a put and then buy a put to protect ourselves. I don't like selling puts just in general in this marketplace because we see the fear factors out there, like the VIX being around 29%, the implied volatility on this underlying around 60%. So let's look at that trade and see how this plays out, okay? So here's the chain on Hartford. It is up today about 2%, so that's a decent move. I think it's a little bit better than what the markets are doing right now. 39.02 was the last trade. The expirations that we can choose from, they have weekly expirations in this underlying, so we're going to do the July 2nd expiration. It's going on about 31 days. So this isn't a short-term trade. We're actually doing it thinking, well, if the stock does come down to the bottom of that channel, we're hoping that, oh gosh, I'd be happy to buy it at that range. And where was the bottom of the channel? Right around 35. So these are the Ally Invest option chains. And let me talk a little bit about what you're seeing on the screen. We see the underlying stock here at 39.03. That's a live quote. The markets are running right now. We have the, excuse me, we have the call options on the left, and we have the put options on the right. We're doing the short put spread, which is highlighted here in the options playbook, which means that we're going to be selling an option contract, bringing in some premium, and then using that premium to buy some protection on the downside. Now, if I'm doing this, I need to pick what strikes. Why am I picking these strikes? There's two reasons why I'm going to pick this strike. One of the reasons why is if I look at the most at-the-money option contracts, where the put and the call are basically at the exact same strike. They're very close. So the market's at, yeah, it's 39.03 actually, and the call is trading for 221 on the ask, and the put is trading for 215 on the ask. So we're going to call it, let's go $4.50. Now that's what is considered the expected move over this expiration. They're saying that's a potential move that could happen in the options contracts. By just looking at what the price of the call and the put is, it gives you a little bit of insight as to what the marketplace is thinking. It's all time premium. That's what they're willing to pay. There's no real intrinsic value because we're right at 39. That's where I'd like to start when I'm looking at doing short put spreads or short call spreads. I want to be outside of that range. So we're going to go down from 39 down to 35. That's where we're going to sell our option contract. And we see right now it's trading 67 by 90, a little bit of a wide spread. But by doing a spread that can kind of help us a little bit, we're going to work this order a little. And then we're going to go down 3 points and we're going to buy the 32 strike. So if we look at the Ally Invest workbench, strategy workbench here, and I'll get the profit and loss graph up and running too. Let's zoom in on that a little bit. All right. So if I look at the workbench, when I started looking at this trade, it was closer to 50, but the market has moved up a little bit. I like the 50 number better. Obviously, I'd rather have more than less. But right now, the midpoint's at 43 cents. So we would want to work it somewhere in that range. Let's call it 45 to make the math simple. So I'll put this in the right rail. This will officially be our paper trade for the week. And I'm going to put, now the market's not quite there. Like I said, the market has moved up a little bit on us. So net credit of 45 cents is somewhere where I would try to work this order. A midpoint fill is never guaranteed. Nothing here is meant to be a recommendation anyways. We're all just looking at paper trades on this. But at one point in time, we probably could have filled fairly close to that. Don't forget to think about commissions too when I'm doing this trade. So where's my risk? If I do this trade, the risk is that I could lose 3 points. If I bring in 45 cents, I subtract that from my risk. So my total risk here is $2.55. My total upside would be 45 cents. So if I'm doing that and I look at this and I say, okay, 45 cents on a 1-by-1 spread, that would be $45. The stock if the stock was trading at 35, where that put is at, basically you're looking about bringing in about a 1.5%. $50 on $3,500, if the stock got put to you at that range, 1.5% of the price of the stock. Okay, so if I'm doing this, I'm trying to make that over a month. That's a decent amount over the month. But my goal may be, if I sell this, here's where the stock is at. Let me get rid of the paper trade right now. Here's where the stock is at. we wouldn't mind on this underlying if the stock came down to the to the bottom of the channel, which basically means it would go down a little bit more than the expected move, which the marketplace is saying that's about where the line in the sand is. And if it goes beyond that, I want to be prepared to maybe buy some of this stock. This wouldn't be a bad level. I'd be at the other end of the channel. Hopefully we get that break back up to the upside. And this is where I'd look to maybe buy 100 shares via the put. If the stock comes down and is trading between 35 and 33 here, or, yeah, 32, I guess, 35 and 32, that's where a strike is at, then the stock may be put to me. That means I'd have to buy 100 shares at $35, or it would be $3,500. And this is what I mean by a fear of missing out. I'm bringing in some income. I'm using some of the cash that I have available. Now, my maximum risk here is only $2.55 or $255 less commission, or plus commission, I should say, in that instance. But if I do this trade here, I don't mind buying the stock. And that's kind of my outlook here, is that if it comes down, I want to be prepared to buy that stock. And if not, oh well, I made my 1.5% over the next 30 days, and I actually put my capital to use. All right, so Lindsey, let's get and see if we have any listener questions out there.
I'm not seeing any questions at the moment, but if you're watching, feel free to type something in. We're happy to answer your questions now. Brian, we did have something from last week that came through when we weren't able to do the live chat real time, and it was from Adam Williams. What's the most you can earn on the Walmart long call spread that we did last week?
All right. So as I mentioned already on this video, in that we did a more speculative trade in Walmart going into earnings, and we had a little chop in the marketplace. So we did this, we set it up on purpose where we had basically the same amount of risk as we did the downside. Actually, at some point in time, it would have been the exact same, in that we did a 5-point wide spread. That's the maximum you can make, is the width between the strikes. And then we paid $2.50 for it. So the maximum we could lose on a long debit spread, or a long bull call spread is another name for it, is what you paid for that underlying. So it'd be $250 for every 1-by-1 spread plus commissions. And our upside, the maximum we could trade for, is $5. So you take $5 minus $250, and you see that our max upside was basically, or well, not basically, it was the same as our downside in that scenario. And we did have an interesting stock play of the day overtime about Walmart, because we had some chop in the marketplace. And I talked about how you might want to roll into a strategy that's called a long butterfly. So just interesting how the whole trade played out. The stock play of the day overtime is always taped on Fridays at noon Eastern time. And we'll be doing one this week at the end of the week in regards to our trade here in Hartford.
All right, you got to check out the stock play of the day overtime on Fridays. It's really great. Brian does a recap of the trade and makes any adjustments that might make sense depending on where you get in. We did another question popped up, Brian. Let me just see. Talal Hassan, is the profit loss ratio for your HIG trade something you would be comfortable with in your usual trades, i.e. max loss of $300 versus a max gain of $45?
Yes, that's a great question. And here's one of the biggest things. All trades are relative to probability. You have a higher probability of success because we went outside the expected move on the underlying. So the probability that option, that underlying stock, and it's all just looking at the math of the market and the math of the option option contracts that are involved in the pricing of it, is saying that there's a lower probability that these option contracts will end up in the money. So whenever you have that, you're always going to have a lower upside relative to the total risk of that trade. And that's what we're seeing here. So it's all about probability of success. If you have a higher probability of or a lower probability of success, well, then you're usually going to have more upside than you do downside. So it's all about how you want to approach the trade. We're looking at this as we might not mind buying Hartford if the stock comes down to the lower end of the trading range right now. So we're going to put some capital to work right now. Hopefully the stock will come down and we get the opportunity to buy it, and then we can get long Hartford using the option contracts. So it's a little bit of a different approach. And in general, I am comfortable with that type of risk, mainly because I'm trying to use it to actually buy the stock. And that's a common thing that I would do on extremely volatile underlyings. Right now, it's showing 60% implied volatility. We're getting a lot of juice, if you will, to use that technical term, for selling that option contract. So that's one way that we can approach it.
Yeah, and so Brian, there was another question too from Sim. He wants you to talk about some of the scenarios where you would either let this expire or considering closing this at some point before expiration.
Well, that's a very good question. Actually, I probably should have addressed that. If you are doing this trade, and you see in the short term, it's a 30-day trade, right? Let's say over the next 10 days or so, this spread starts trading for around 10, 15 cents. I would think about getting out of it. I almost always would rather take off that risk than keep that risk on to just try to capture the last, let's say, 10 cents of profitability in the trade. So even though I might want to still buy that underlying, if I do see this thing trading down around the 10 or 15 cent level, I have a tendency to take off short puts just to remove the risk. I could still buy it if the stock goes down, but I just soon get that risk off if I can. If it happens, in particular, let's say we get a run up of the, let's say, 3 or 4 points over the next couple of days, I would really think about doing that. So yes. Now, on the other side, if you were not planning on buying it, you're going to take a different risk approach to this. If I can make 40 cents on this trade, and that's the maximum I can make, and I'm really doing this only to try to capture the time premium and not thinking about actually buying the underlying stock, well, a lot of times I just like to say, well, if I can make 40 cents as my max, my risk that I'm willing to take is 40 cents. And if I see this trading for 80 cents, which means it went against me and I'd have to close it for 80 cents, basically losing the maximum that I could make, I will get out of a trade in that scenario. If you have that opportunity, that's one of the things. The markets would have to be open. You'd have to be able to trade. A big gap down might hurt you in this scenario, but that's why we buy that put. We buy that put to help us against a ginormous gap down. And in this marketplace, I think it's very important to do that.
Well, and Brian,
got another one too.
Yeah, one last quick question for you from Charles. We only have a couple minutes left, 1 or 2 minutes. This has a dividend. How does that affect the holding or your trade idea?
Okay, if stocks do pay dividends, and we can scroll all the way up here, we can see the dividend here. It pays it looks like it's going X on the 29th. And the dividend is 33 cents. So it just happened here. We just went ex-dividend. So the dividend didn't play a factor in this, but if an option contract does pay a dividend, ultimately when that dividend gets paid, what happens to the stock? The stock price goes down by the amount of the dividend. And it opens unchanged, if you will, the next morning, but it would be down by that dividend amount. And in this instance, it pays a quarterly dividend. The last dividend was 33 cents. So with that said, the marketplace knows that dividend is coming. It's usually announced in advance. So what's that going to do? If you think about it, if stock goes down, what does that do to puts? It increases puts. And what does it do to call? It decreases calls. So if it's a known dividend, it will be priced in. And you will know it'll be priced into the option contracts because they know that stock is going down by that amount. So what does that mean? If the stock was paying a dividend, you would expect to get less for your put options overall because the marketplace is actually pricing in that downturn before the dividend gets paid overall.
All right. Great answer. Great answer.
Great question.
Yeah, great question. A lot of great questions too. Thanks for your participation today. We really appreciate that. The Q&A box the chat box will be open for a few more days. And don't forget, Stock Play of the Day Overtime on Friday at noon with Brian. He will review this trade and make any adjustments that make sense, or suggest adjustments that could make sense, I should say. But that's going to wrap it up for this week, Brian.
Oh, yeah, it is. And I will address, if anything happens in the trade, we'll talk about what we can do to adjust the trade next week. It's a longer term trade. So please click subscribe and hit the bell, and we'll see you this Friday on the Stock Play of the Day Overtime. Thanks for coming, everyone.
Thanks.